Cannabis consolidation is inevitable, so we're going to take a look at a report from Viridian Capital, a couple other sources as well, and look at $500 million that some multi-state operators owe the IRS. And then finally, dive into what cannabis subsectors are still attracting equity capital. All of that coming up.
It's only entertainment.
Welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your Cannabis Business Podcast. So when we take a look at this report from Viridian Capital, we can see that the 6 largest U.S. MSOs have a combined accounted for $5 billion. That's 20% of the cannabis industry revenue in 2021. No single competitor represented as much as 5% of the total. Almost 2/3 of the industry go towards about 9,900 small companies that average revenues are of around 1.6 million each. In contrast, the 9,100 craft beer companies represented 27% of revenues. I'm definitely seeing a lot more automation and scaling that takes a lot of capital. It's definitely capital intensive. So there's a lot of investors, a lot of especially in Missouri and Maryland that we just saw, a lot of interest in those areas as well. And they're going to need a lot of equipment, a lot of money, and a lot of hand holding. That's going to be a huge driver of consolidation, is just the amount of the cost of capital and the amount of money that's needed. Case in point, if you look at the average valuation multiples for the largest multi-state operators, more than twice that of their tier 3 competitors. So that's implying an enormous cost of capital advantage that it takes. It makes it nearly impossible for those small companies to maintain that growth, and takes them to kind of that next level of consolidation. They're going to have a lot more power to be able to grab up producer, processor, retailers, vertically integrated anybody they want in any region in a matter of time. That's going to be a natural life cycle. We've seen that in a lot of other areas, and the phoenix will rise from the ashes eventually. We'll get some craft growers eventually. That is if they can survive, since a bunch of them owe a ton of money. There's at least 10 multi-state cannabis companies that are owing $500 million to the IRS. So, and we've seen this, I've seen it a lot. People just don't pay their employee taxes. They look on the surface to be a really well-run company with a lot of capital. They're driving fancy cars, and then you realize they just don't pay employee taxes or whatever. In this case, the MSOs are Acreage Holdings, Ascend Wellness, AR Wellness, Cresco, Columbia, Curaleaf, Green Thumb, TerraScent, TrueLeaf, Verano Holdings. I've talked to a few of those people between the Talking Hedge and Seeking Alpha. Some of them I know are debt-free, and maybe this is why they forgot to pay, didn't pay, chose not to. I don't know. I just find that interesting. So out of all those that I just listed, collectively, they owe almost $508 million, but Curaleaf and Verano combined owe the IRS $286 million. Curaleaf, man, wow. They just have no idea. They've lost a lot. So Verano owes $161 million. They only have $92 million cash on hand. So 78% more in taxes than the company actually has. Good luck with that. So back in May, Seeking Alpha, we reported that there was worrying financial trends. We mentioned some of the obvious, like 280E, as well as the lack of other deductions. More than likely, the IRS is just going to allow them to get on a payment plan, and they'll be able to just pay them off like any other creditor, long-term debt, some kind of situation. Moving on to what the Canadian cannabis companies' excise debt looks like. They're not immune to it. So there's a lot of Canadian companies, they're failing to pay their own federal excise taxes on time, and trying to defer that tax bill in order to meet more pressing needs, like, I don't know, paying their employees. Up in Canada, 172 companies owe approximately $72.5 million US. So it's not as bad. Some of these issues shouldn't come as a surprise. They're claiming it's partly to do with price compression, excessive federal and provincial taxation. Some of that price compression was around 50%, but that shouldn't be alarming to anybody. A lot of people think that they're going to get $5,000 a pound. In the end, I've seen pounds of sold wholesale for $10. That's an ounce, $10 an ounce. So I just heard how in Vegas, $150 at the wholesale level. So that's pretty low. That's ridiculously low. But you should count on whatever you're charging to come down to normal at some point. That's good for consumers. Maybe not so good for the growers. But a lot of us knew it was a commodity and a race to the bottom in terms of pricing, anyways. Looking at low liquidity and then challenging markets, leading to some debt restructuring, according to Viridian. Looking at the capital markets being challenging, just like anything else. Right now, everyone's on the sidelines just waiting to see what's going to happen. So that equated to only 72.5 million in equity issued to U.S. cultivation and retail compared to 2 billion in the same period last year. So looking at this chart, we can see low liquidity measured if it's under 1.2, and there's nobody that's at that level. So they're highly leveraged. Unrivaled in State House, for example, they're vulnerable with tight liquidity, high leverage, and being in the California marketplace, slow to kind of turn around. Taking a look at another graph from Viridian Capital, since capital markets are so constrained, taking a look at this is the debt equity that investors should be monitoring for credit quality. This shows smaller public and private companies have constrained access to debt, and rates are likely to be higher for them and contain equity kickers for many of those companies. Companies with liquidity pressures, that's maturing debt, they're going to be subjected to effective costs as high as 30%. A lot of people aren't going to be able to afford that. Let's follow the money and kind of see where some sectors are worth investing in, according to the people throwing their money, which apparently is off 64%, with cannabis capital raises year to date being down almost 2/3. Total equity issuances is off 75%. Debt issuances is down 45%. If you look at just in the United States, debt is down 31%. Canadian debt is down 80%. You definitely don't want Canadian debt issuances. 80% down is like significant. At 61% of total capital raises, debt remains the highest in history for comparable periods. Public companies accounted for 73.6% of that total financing year to date, down almost 79%. So looking at this graph showing that U.S. activity dominated capital raises for the first 43 weeks of the year, accounting for almost 75% of all capital raised. So nobody's investing up in Canada. Total capital raised is down 66%, but equity capital raised is down approximately 96%. When you look at debt financing, that's down 47% year to date, accounts for about 95% of all capital raised. Private companies raised 23% of it. 76% of total capital raises year to date were completed by public companies, compared to 85% last year. Cannabis stock prices were down over 6%. They just kind of moved with the noise in the news, probably popped with some of Biden's comments about descheduling and then a bill passing about allowing for research that will hopefully deschedule it entirely. In the meantime, we're looking at negative industry trends, tight capital markets, pressuring some of these lower tier companies. So restructuring is going to happen. Consolidation will happen. Year-to-date stock performance for tier one multi-state operators might be doing okay. Of course, that's relative to everything else. I mean, all of these are just getting smashed at least 40%. So is that a buying opportunity? I don't know. I think the risk is really high. And so, I mean, of course, this is not advice. It seems a bit too risky. Looking at stock performance between multi-state operators, like GTI, they were up almost 27%. Forefront they were down 32%, not doing so hot on that one. Canopy growth, um, they were up 33%. That was one of the higher jumps. I'm talking about like late October. So when that happened, cannabis companies unfortunately get lumped together and their stocks don't move really independently. You could then therefore look at some of these as, a value stock, but you got to really dive in, look at some of the fundamentals. And I don't think people do. They're just throwing money at the industry as a whole, and you can see it doesn't work out for all of them. Green Lane was one of the worst performings. It's down 70.6%. Not very good. So let's see where some of the money is flowing into. Cultivation and retail had two, psychedelics had one, software and media had one. So not a whole lot of money being thrown around as of late October. This report's about 3 weeks old. So it's still relevant. Debt raises still accounted for 86% of all of the capital raised during this time frame. Very small snapshot here. Most of that came from Terrace and AR Wellness. The two had already completed significant refinancing. So some other companies are probably going to take similar paths to that. As we mentioned, some of the debt restructuring that we're anticipating. Verano already had to restructure $350 million of its existing credit line. So you're kind of seeing some of that disconnect between credit quality and interest rates right now. And there's going to be some of that debt restructuring coming. As soon as interest rates start creeping up, it's really going to kind of destroy a lot of folks who have been just trying to get by. Folks that haven't been doing a very good job of operating the business are going to be shown as folks who just need to get out of the way. And as interest rates increase, we'll see a lot more of that consolidation as a result. People that, FTX is a perfect example of that too. We saw that during Bernie Madoff, the Ponzi scheme. Anytime interest rates rise, it kind of really flushes out some of the trash. And I think we're going to see some of those folks who, when times were good, weren't operating as they should have been, like the Canopy growth and Tilrays and folks whose stock prices are taking a beating because of that. Let's look at mergers and acquisitions. Total year-to-date M&A volume is down 80%. Only 4.7 billion in consideration, 14 deals closed. If you compare that to last year, almost 24 billion in transactions from 273 deals. So a lot less activity done. And the 4.5 billion Tilray acquisition of Afria, and then the 7.2 billion Jazz Pharmaceutical of GW Pharma were last year's big transactions. But without those two mega deals, they would only be trailing by 61% year to date. US volume is down 67%. There's 40% fewer transactions, and the size of those is down too, from $34 million. That's down by 45%. So half of everything. And finally, we'll just take a look at the capital raises. Again, this is as of late October, showing the difference between 2022 and 2021. Public companies raising equity, only 81 transactions for 1.1 billion versus almost 5 billion last year and 229 transactions. So it's a considerable amount, a considerable difference there. M&A activity is still dominant on retail, and then picking up some distressed cultivation, but not a whole lot on brands. That was in MJ BizCon in Vegas, world's largest cannabis conference. Didn't hear a whole lot about brands being bought. So people want to pick up cheap cultivation, and definitely grabbing retail, and a lot of movement in the Northeast, Missouri, Maryland, and New York, all of those new emerging markets picking up. So a lot of stuff going on, a lot of money moving around, a lot of consolidation expected. We'll do some more of these next year, but for that, I think we're going to have to roll this one up. With that, we're going to roll this one up. I'm Josh Kincaid. This is The Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out. Don't forget to smash that like button on your way out and check out these other videos that we've got.